and it's my pleasure to open the session on global climate funds, the experience with multilateralism. And this theme touches one of the central challenges of our time, how to finance both climate change that will be more effective and just. And I want to raise some words at the beginning. Climate funds were established in the promise of bridging the gap between the present vulnerabilities. And I want to call attention to this concept. It's a multidimensional concept, and I think that is very useful. And the future. So to bridging the gap between the present vulnerabilities and the future. And where innovation and anticipatory governance will help to alleviate them. One of these possibilities is by transferring resources from the global north to the global south, not necessarily the most effective one. As yet, we know their performance has been uneven, raising important questions about governance, equity, and effectiveness. Our panel today brings 4 distinguished voices who will approach this issue from different but deeply complementary perspectives. First of all, I want to introduce Professor Richard Kozul-Right. He was the former director of Globalization and Development Strategies Division of UNTACT, and now he's professor at SOAS, University of London. And if I know his previous works, I would say that he will situate global climate funds within the broader architecture of globalization and finance, pointed to the structural limits of current arrangements and the urgent need for systemic reform. The second professor who will speak here is Charles Abugri, who is the executive director of IDEAS. And he has a long experience in African and international development debates, and I probably think that he will remind us of the justice dimension, that climate finance cannot be understood apart from historical responsibilities, equity, and the need for the South to have a stronger voice in governance. And then comes Bruno Conti, who is professor of international economics in the State University of Campinas, and is also research in the Center for Conjunctural Studies and Economic Policy, and in Brazil-China Studies Center. He's also a researcher of Transforma project. I think that coming from Brazil, probably, we'll be exploring tensions between fiscal constraints, domestic planning, and the role of multinational climate funds in supporting or sometimes constraining developmental trajectories. And finally, Marcos Vinicius, from the World Bank Group Executive Director for Brazil, Colombia, the Dominican Republic, Ecuador, Haiti, Panama, the Philippines, Suriname, and Trinidad and Tobago. And probably will enrich the debate with empirical insights. Probably, he said that it will be more genuine, so it probably will not really talk about empirical insights, especially from Brazil and Latin America, on concrete experiences of assessing and deploying resources from these funds, highlighting both obstacles and opportunity. And I think that together these contributions will allow us to think better from the general theme, the general issue of this session here. So I'll start by giving the floor to Professor Richard Kozul-Right.
Thank you, Anastasia. Good afternoon to everybody. Thank you to IDEAS and to the Institute for the invitation. I do have a PowerPoint, but I'm not going to use it. It had too many slides, and they tend to get in the way of present. I lived for a long time in Switzerland, which is a very funny kind of popular democracy, and if you can gather 100,000 signatures, you can have a referendum on anything in Switzerland. And one person did try and get a referendum on banning PowerPoint presentations in Switzerland, and it narrowly failed to get the necessary 100,000 people. But I have a kind of sneaking admiration for whoever tried to do that. So for those that are interested, I do have a PowerPoint, but I'm not going to use it and sell you. As you said, I want to situate the discussion in a wider context, because for the obvious reason that the multilateral climate financing agenda can obviously not be situated from the way in which multilateralism has evolved over the last 80 years and the way in which it currently operates, which I think essentially excludes multilateral institutions from solving the climate and related development challenges. And that's where I want to get to, but also to suggest an alternative narrative where I think developing countries need to focus their energies if they're going to meet the multiple challenges that many of them continue to face on a daily basis. In terms of someone asked, I think, Jomo, about what multilateralism was in his presentation yesterday. And it's a very simple idea, really, that states are willing to give up a certain amount of national sovereignty to bodies that can undertake collective action and can pursue goals that would otherwise not be pursued or to be under-delivered on. That's the basic rationale, I think, for multilateralism, and that was certainly the idea of the in the first half of the 1940s, when the current multilateral architecture was created. It was not, and it's very important, I think, to understand what the intent of the original architects of multilateralism were trying to do, because it's not where we are today, and in many respects it's the opposite of where we are today, at least for me. And you know, as someone who went to Cambridge and who thinks that, you know, everything good in the world came out of the writings of John Maynard Keynes, Keynes was not the main player at Bretton Woods, and the multilateral financial institutions were not a kind of outgrowth of the general theory. They were a product of the New Deal and the New Dealers, and it was an American project in that sense, and it was a good project. I think for a period it really was. It offered an alternative that we, in many respects, miss today. It was based upon a simple consensus that challenges like peace and development could only be achieved collectively, that they were somehow public goods and had to be understood as public goods. They were indivisible, and you couldn't just have a little bit of one or the other. You had to deliver comprehensively on both a peace and a development agenda, and you needed a set of dedicated institutions that could orchestrate and deliver those goals, and that was what the Bretton Woods institutions and the UN and subsequently the General Agreement on Trade and Tariffs were trying to do. And you also needed a responsible hegemon to somehow hold things together. And the Americans at that point saw themselves in those terms. And compared with other states in the advanced world, they were far more progressive. I think people forget this. They were far more progressive than their European counterparts in the 1940s. I mean, you know, the UK government under Churchill and his acolytes was not a progressive government in the 1940s. And they had some clear objectives, I think, when it came to what these institutions were going to deliver. I think they had a clear understanding of what they thought they were going to do. And I think the best account of it, and the one that I always go back to, is the justification of the Bretton Woods Agreement that was given by Henry Morgenthau, who was the president of the Bretton Woods Conference as the US Secretary Treasury Secretary, and he had to, because there was no guarantees that the agreement would be accepted by the U.S. Congress. It had to be voted on and agreed to, and there was, given the nature of the politics in the U.S. at the time, there were no guarantees that that would happen, and so Morgenthau had to go to what was then the Banking and Monetary Committee, the House Banking and Monetary Committee, to defend the Bretton Woods agreement and why it was not only good for the world, but good for the American consumer and business community. And that's what he did in a very succinct and brilliant 5 or 6 page account of what the Bretton Woods institutions were going to deliver. And basically he said there were 3 rationales for the institutions that were created. The first one was to avoid deflationary adjustment to imbalances. The kind of response to the shocks of the 1930s that led to the economic chaos and contagion that not only proved economically damaging, but ultimately proved politically damaging and was ultimately a source of global conflict. So avoiding deflationary adjustments, and that essentially was the job of the International Monetary Fund, ensuring financial stability. The second was to ensure that finance had a public role, what Morgenthau referred to as serving the general welfare. And that was to ensure access to affordable long-term financing, initially for the reconstruction of Europe and subsequently for development goals. And that was basically the job of the World Bank. And the last one was it's an interesting one in light of the current circumstances. The last principle was to avoid bullying of big countries by big countries of smaller countries, avoiding beggar my neighbor policies. But Morgenthau used that language of ensuring that there were a set of rules and mechanisms that would not be captured and used by the powerful to subordinate the less powerful. So those were essentially the 3 principles on which the original designers of the Bretton Woods system believed that they were creating the basis for a more stable and more prosperous and more peaceful world. And of course, it was never a perfect, and in many respects, the pushback against that begins with Roosevelt's death in 1945 and the replacement by Harry Truman, who was never a New Dealer himself. He was on the fringes of the New Deal. He never voted against New Deal legislation, but he was never a member of that kind of hardcore New Deal group in the United States. Obviously, the emergence of the Cold War was an important ingredient that distorted that original vision. And probably most importantly of all, the American business and financial interests who had been deeply destabilized by the events of the 1930s and the early 1940s began to regroup and reorganize and push back against domestic New Deal legislation from 1945, 1946 onwards. And so the last throes of that New Deal multilateralism, I guess, were the Marshall Plan, which in many respects remains one of the best aid programs that the Western countries have designed, again, with lots of weaknesses, but a remarkable achievement in many respects. And the International Trade Organization, which was the trade counterpart of the financial institutions, which never got off the ground because by the late 1940s, when it went to Congress, there was no way it was going to get through, and Truman himself never put the legislation on an ITO to the U.S. Congress, and so what I would call a bastardized multilateralism, to borrow a phrase from Joan Robinson, was what emerged at the end of the 1940s and early 1950s, which had some of those elements of the original designers, but was much more tolerant of private finance capital, I think, than the original New Dealers were. They tolerated the emergence of the euro-dollar market, which emerged as a way for capital to circumvent many of the rules that countries had in place to manage capital flows. As many of them I'm sure know, the original, the bastardized multilateralism didn't really have a place for development in its agenda, and developing countries, as they became independent, became much more frustrated with the operations of those institutions, etc. And so that was that as it was up and running in the 50s and 60s and into the early 70s. It was a very bastardized form of multilateralism, I think, that emerged and then collapsed in the 1970s thanks to internal dynamics in the United States that led Nixon to remove the fixed dollar, the fixed exchange rate system, and of course pressure from developing countries as they fought for a new international economic order through the United Nations rather than through the Bretton Woods institutions. Those efforts at a more progressive attempt to redefine multilateralism in the 1970s obviously failed, and the multilateralism that emerged and the one that we're still living through that began to take shape in the 1980s was really a kind of privatized form of multilateralism in which the interests are, the private interests steadily became a much more influential force shaping the operations and objectives of the multilateral system, and that was particularly true in terms of the interests of private capital, which, and I would argue that the multilateral institutions, the World Bank and the IMF and their various offshoots, essentially became handmaidens for private capital from the late 1980s onwards, and that's the system in which private capital, particularly private financial capital in the case of the Bretton Woods institutions, and large transnational corporate interests in the case of the WTO when it was created in 1994, is the system that we are living through now. It's a privatized system in which the power of capital is the singular most important influence in terms of the direction and objectives of that system. And I would argue that's why it's a system that can't meet the climate crisis fundamentally. Having said that, of course, it's still important to admit that there are still obvious advantages to multilateral finance compared with private capital flows. I mean, it's still cheaper, it's still more stable than private capital. And as the work that we've done with Kevin in the Boston University has shown, it's a system that delivers finance on too small a scale, too late for the problems that it's meant to address, and too aggressively in terms of the way in which the borrowers from that system are treated. Policy conditionality, the lack of sufficient concessional lending, the move away from grant-based financing, all those things point to a system that is not fit for purpose. It remains highly biased in terms of the nature of the bias towards creditors, bias towards wealthier countries, biased in the sense, as Jayati pointed out yesterday, that much of the finance remains pro-cyclical rather than counter-cyclical. So it's unduly biased, and as a system, it remains too unrepresentative. The way in which decision-making is made remains, as you all know, highly skewed in favor of countries that no longer have the kind of power that they had when those institutions were designed, in terms of voting power, in terms of setting the agenda, in terms of ideological influence. That kind of unrepresentative nature remains significant. And as a consequence of that, the numbers that we talk about with respect to multilateral, they just don't. They didn't add up when the challenge was a singular set of development challenges, and they certainly don't add up when those development challenges are compounded by the climate-related challenges. And these two are now interacting in ways that magnify the scale of the challenge that we're talking about. And people have mentioned the numbers. Chandra mentioned them this morning, the kind of trillions of, and it's a kind of bit of a pointless exercise to some extent, and there's a lot of huge guesswork involved, but we know it's in the trillions of dollars. If you take the report by Stern and Songwei and Bhattacharya, I think the last one that they produced for the last COP, the figure is in the order of $2 to $3 trillion annually for developing countries, excluding China. If you add the SDGs to the climate and to the Paris Agreement, and you mix the Paris Agreement with the Sustainable Development Agenda, UNCTAD estimates that the number is in the order of $7 trillion annually. And clearly, the kind of numbers that we see coming out of the climate financing process are nowhere near that. They were insignificant coming out of Copenhagen, but the numbers that came out of Baku were clearly not fit for purpose when it comes to the scale of the challenge that we are talking about. In terms of the way, and what we're talking about is, and Joma will appreciate this because this goes back to work that we did back in UNDESA in 2009. I mean, we're talking about a massive investment push is what is required to meet the combined development and climate challenges that most developing countries face. It's a massive investment push. We in a forthcoming paper, myself and Kevin and people at Boston University, have framed the challenge essentially as a triple movement, borrowing a little bit from the work of Karl Polanyi, who talked about a double movement. Most developing countries actually face a triple movement. They have to diversify their, and I would argue still, primarily, they have to diversify their economies first and foremost. You know, and this is an indictment of UNCTAD, over 100 developing countries are still what are labeled commodity dependent. That is, at least 60% of their foreign exchange earnings depend upon 2 or 3 commodities. Over 100 developing countries are in that position. 3/4 of those countries still earn over 80% of their foreign exchange earnings from commodity exports. And UNCTAD was set up to remove that situation. Clearly we failed to do that, or someone's failed to do it. We're not the only guilty party in that respect. But diversification remains a principal challenge for all developing countries. At the same time, they have to decarbonize their economies. As they grow, they will use more and more energy. Most developing countries remain energy poor, and they need to use more and more energy. If they use it if they use the same energy pattern that the advanced economies use, then the planet is cooked. I think we know that. So, although their responsibilities, as was talked about this morning, are different from advanced economies, decarbonization remains part of a progressive development agenda. But arguably, for many of those developing countries, adaptation, the third movement, is actually as important as decarbonization for many developing countries, because the damage that they are already experiencing from climate shocks is so significant. And so we have a system that is not delivering, and it's not only delivering on the scale required, the kind of ideology behind it, what Daniela Gabor calls the Wall Street consensus, in which private capital will somehow solve this big investment push through things I'm sure you're all familiar with, blending techniques and public-private partnerships, and other related ways of enticing private capital into doing things that it wouldn't do because they're not sufficiently profitable, is an approach that simply will not fill the kind of financing gap that we talked about, which is why we need more public finance. The problem is that public finance is not going to come from the multilateral system. So what do we do? If we don't think the multilateral system is capable of delivering on this kind of scale, we need a different kind of narrative. We need a different set of strategies that will actually fill the financing gap. And I would say there are three elements to that strategy that we've talked about, and I'll end with this without really going into them in any kind of detail, but we need a three-pronged strategy that can offer an alternative to the failed strategy of what the multilateral system currently operates on and around. The first one is a much greater focus on domestic resource mobilization. Developing countries are wary of this because they believe that, and rightly, that in a sense lets the advanced economies off the hook. And that is true. But whether we like it or not, that's the world we're in. And we need developing countries to do what countries like China have done, to raise more resources domestically. And we can have an argument about China being a special case and we can't but unless you can raise your domestic investment levels to at least 30% of GDP, which very few developing countries have been able, you will not meet this challenge in a systematic and inclusive fashion. So that, and we had a talk about, I was slightly annoyed, that's probably a strong word, Jayati. The discussion this morning on profit and social, we didn't talk about profits. The thing about domestic resource mobilization, we have to save it from the IMF World Bank interpretation of what domestic resource, because they will try and monopolize that discussion too. And in that, when you look at China or the East Asian economies, the role of profits and the links between profits and investment are a critical part of the domestic resource mobilization story. And we don't talk about, as progressives, we don't talk about that relation sufficient. But anyway, domestic resource mobilization, not public-private partnerships, but public-public partnerships. That is the public sphere. That includes central banks, that includes treasuries, it includes a critical role for national development banks, it includes sovereign wealth fund, it includes government procurement strategies. There's a huge ecology out there of the public realm that needs to be better mobilized to achieve that. And we did some work, Kevin and myself did some work on improving the links between national development banks and multilateral development banks, which is a missing link in the discussion of the role of those institutions and the support that they can lend. And that needs to be, we need to scale that up significantly. And the last one, of course, which we've begun to talk about already, is South-South cooperation and the new opportunities that come from a world in which we have new players from the South, new institutions emerging in the South, dealing with both long-term and short-term capital flows. And all that needs, and that agenda which has gone by the roadside. I mean, as someone who was part of UNCTAD and the G77, the G77 have abandoned South-South cooperation in a meaningful sense. And we need to recover it, not only from northern donors, but from many parts of the South too, if we're going to get the kind of architecture we need to meet all these challenges. So sorry I went on too long, sorry.
Well, thank you for this wonderful presentation, and also for reminding us that globalization at the very beginning stand by the providing public goods, providing international public goods. Thank you. So I now give the floor to Charles Abugri, please.
Thanks, Nasilia. So I have a PowerPoint, but I would also, like Richard, not project it except one page. Yeah, but it allows me to breathe. Yeah. Okay. Even then, they can't find it. So, okay, so just the third, okay, that's the wrong one, but the third, just go on with this is the only one I want to project. This tells the story of the climate finance architecture. As you can see, it's a messy, complex fragmented system which combines old systems of multilateralism, multilateral institutions with multiple bilateral initiatives and relationships, some risk-related initiatives for the private sector, but also regional, national, collaborative initiatives and channels. If you add to these national level structures and initiatives, the system gets even more complex. This system is only able to catalyze for what has been recorded, been able to be recorded in 2023, no more than $100 billion for an ambition and a need that should run into trillions. The system works on old and decaying power relations of a colonial system of relationships between so-called developed and developing countries, and it maintains those power relations. As I would argue, it is difficult to reform. So first, the amount it generates is small relative to need. Most of it is debt related. So in 2022, over 65% of what was disbursed through this formal system as laid out was in the form of debt. Nearly 90% of the resources flowing through this system went through the multilateral development banks. The majority of it went through the multilateral development banks, and 89% of the resources flowing out of the multilateral development bank as climate finance was in debt form. However, the actual total climate finance recorded domestic compared to international is overwhelmingly the bigger share of total climate finance comes from domestic sources. So East Asia and the Pacific, total climate finance, recorded climate finance, 95% or more in the year 2023 was domestically financed. But of course, that declines as the continent or the region gets poorer. So for sub-Saharan Africa, recorded climate finance, 23% of it was from domestic sources. So the first relationship is the climate finance and the scale of climate financing. Not only is the burden domestic, but the ability to raise it correlates with the state of economic development, the capacity to generate it. Secondly, of all climate finance, majority of it is public. However, the share of the public sector of total climate finance also varies with the state of economic development. At the national level, however, national development finance institutions across the board are the dominant actors, side by side with government. But the more dominant national development finance institutions depends also on the degree of financial deepening in the country and the role of development financing in those countries. The ambition that Richard flagged of the 2020 report, the G20 report of the need, it's the projection that by 2030, annual incremental investment should be in the order of 3 trillion, incremental, from 2030, from where we currently stand. Of that incremental investment, 2/3 of it is domestic. It's meant to be mobilized domestically. And the other third, internationally. Of the international sources of finance, half of it, 50%, is private, and the other 50% from official sources, both multilateral and bilateral. As we are witnessing already declining concessionary finance, in fact, in 2024, the OECD recorded for the first time a decline in the contribution of OECD countries to multilateral institutions. So basically, but of course, official development assistance has also been declining. So the trend is clear. From official sources, it is unlikely that even the $500 billion additional incremental contribution allocated will be met. That means, effectively, the burden of climate financing is increasingly domestic, and I would argue regional. And that should be where our attention should be channeled. Also, reforming this system is complex and probably not worth the effort. It involves the reforms of the international financial institutions, the IFIs, the World Bank, the IMF. We've been talking about these institutional reforms almost forever. And the best we've gotten would be some limited progress, both for the World Bank, some small adjustments, say in their capital adequacy ratio, that frees up a little bit of money, and so on and so forth, but never fundamental enough to deliver according to need. It also includes reforming the financial standards setters that establish the norms for the governance of the global financial system. It includes monetary arrangements related to the global financial safety nets, informal country groupings that act as norm setters. And you see all these structures like the G7, the G20, the G that have an influence in the norms that are set for global finance, including climate finance. And then they have multiplicity of creditor groups that influence the system. The Paris Club, London Club, the Common Framework for Debt Treatment, and the G20, and so on and so forth. And the credit rating agencies, for example. It includes tackling the United Nations system itself as a norm setter, but also an implementer and coordinator. It's failed to be both an effective norm setter and even less so to be an effective coordinator of the system. Making these reforms effective to deliver on time and at scale is very unlikely to succeed. There are, of course, some opportunities that where they exist, the reform agenda and engagement, the reform agenda can add some value. And these reform agenda opportunities, we can prioritize, a focus on reforming the G20 capital adequacy framework, for example, that releases some money and within the multilateral development bank systems, we can push for public de-risking of investment in terms of norms, in terms of risk management, and so on and so forth. But what seems to be emerging in terms of innovations that open the possibilities for the future may be regional. There's, of course, the need for a balanced approach that still keeps some of these global reform agendas in place. We cannot ignore them. But there is been in each of our regions a gradual shift to regional mechanisms. And it is into these regional mechanisms that maybe we should pay some more attention and make them more effective. For example, regional lenders of last resort and bilateral currency swaps to stabilize access to liquidity in times of stress. Diversification of reserves initiatives in that direction, development of regional and cross-regional payment settlement systems, ASEAN, BRICS payment systems, the Pan-African payment and settlement systems, and so on and so forth. In each of these regions, you have these newly emerging efforts to address both the risks for raising capital within the region and internationally, but also expanding the scope for domestic resource mobilization. At the national level, we could pay more attention to solutions that enable countries to aggregate their savings and be more effective, to address the taxation question that was discussed earlier in the morning, and to put in place a regulatory system that makes the private sector deliver for social justice, the point that Chandru was making in the morning. Focus more so on regulatory innovations rather than innovative finance per se. There's a lot of effort and attention that we probably can get a lot more benefit from focusing on the regional and global levels. And regional financing arrangements are growing. So the BRICS contingency reserve arrangement already has about $100 billion. There's an African financing stability mechanism that is being established. There's a series of these multilateral funds that are emerging from each region. We probably should take a moment to explore these emerging initiatives, emerging funds, and to help shape them to become more effective and connected as sources of regional and cross-regional collaboration and South-South collaboration. In the poorest continent such as Africa, there are two important sources of mobilizing funds. One of it is, of course, more well-known, government revenue, government expenditure, the role of the central bank in stimulating the mobilization of real resources in each of these countries, and expanding the scope for capital formation and so on. So that's been discussed in the morning, and I think there's a lot more to be said about that. But the one area which the Africans, the recent studies have shown is that there is domestic capital. There are assets that are being managed domestically, and they are managed in local currencies. They are pooled by banks. They are pooled by insurance entities. They are pooled in the form of pension funds and so on. These pooled resources in the African continent amount to about over $2 trillion. But there's not sufficient attention in building on these cross-regional initiatives and pooling these resources that also encourage multiple local currency lending for reinvestment, reducing the dependence on dollar loans and so on. So these initiatives exist, and maybe some greater attention to these regional and domestic sources of capital can expand the pool for financing climate, but also channel for structural transformation of these economies and reduce the the indebtedness. There are other such initiatives in Africa. I emphasize Africa because I think it's far less known what is going on there. The African Union initiated the creation of the African Credit Rating Agency. This was to have a second opinion on the credit ratings, that's coming from the three dominant credit rating agencies. It is the evidence shows that the cost of credit in Africa and the risk rating in Africa seems to create an additional premium, raising the cost of capital internationally. And some of them, both the methodology used for the credit rating, but also the underlying knowledge of the context of the continent that feed into credit rating results. The African organizations feel that there is a bias which leads to additional cost of credit. But there are also credit rating agencies that are focusing on rating not just sovereign ratings, but corporate ratings. And they are African based with the potential to build on these to focus on rating the risk climate in each of these countries that stimulates and encourages investment in these countries and internal investment and the growth of local companies. The African Union also has set up a Pan-African payments and settlement system, and this is built into an entity. So it's the African continental free trade area. So it's an attempt to open up trade, but to open up trade also requires building up. So this entity would help to deal with settlement systems in the hope of encouraging an increased trade transactions using local currencies and multiple local currencies. Several of these initiatives at that time would not allow to say. But the point that I am making here is that if ultimately the burden of financing development lies nationally, regionally, and South-South, we need to look at those emerging institutional mechanisms and innovations. That can be the basis for mobilizing resources for climate and development financing. Thank you.
Thank you very much. I really appreciate this slide of the complexity of global climate finance architecture, and to also point out the importance of regional and domestic sources for structural transformation of this complexity. So now I'll pass the floor to Bruno Conti, please.
So good afternoon, everyone. Is it working? Yes, it's working. Great. First of all, thank you very much, Chandru and Jayati, for the invitation. It's a great pleasure to be here, and also an honor to share this session with Charles, Richard, and Acelia, Marcos Vinicius. And obviously, being the third to speak, some of the issues I will treat here were already mentioned by both Richard and Charles, but I hope I will bring some perspective which will have some new inputs for our discussions. And then I think to start the discussions, it's never enough to remind that we are living a humanitarian crisis, right? That's my opinion, and I guess most of you will agree with that. There is the risk that humanity may just come to an end. And to avoid it, there is this need for collective action, right? So Pedro in this morning was talking about mutirão, this Brazilian word, collective action, which is necessary to deal with this very deep crisis we are now living. And Jayati yesterday was also saying that, well, by definition, the ecological crisis cannot be solved through national solutions, right? Yesterday she said the climate change does not respect borders. And Nkrumah from Ghana, in his book, Neocolonialism, last stage of imperialism. He also says, when he advocates for Pan-Africanism, he says, well, the tsetse does not respect borders, so we have to deal with some problems collectively. He was defending Pan-Africanism, and then we are here talking about multilateralism, right? So the ecological crisis cannot be solved through national solutions. This is the departing point. So we need multilateralism more than ever, maybe, right? But then there is this widely accepted idea that now with Trump, the US is destroying multilateralism, and then many countries in the world suddenly became the new advocates for multilateralism, and this is true, obviously. But this is only part of the story. And in my opinion, taking it like that may be a problem, and I'll tell you why. Because in my opinion, we cannot struggle, and then Richard was also going in this direction, right? We cannot struggle to go back to normal. It's nonsense to do it, to go back to what was happening before Trump. We have to recognize that multilateralism before Trump was not working, right? Both Richard and Kevin are working on that. So, and the pandemic was a proof of that. Crystal clear, we saw that, well, the scandal in the distribution of vaccinations, and then Jayati made also brilliant works on that, showing the problems with multilateralism, with the so-called global governance, right? The situation in Gaza is much worse now, but it's not new. The climate crisis is worse now, but it's also not new, right? So the current situation cannot be understood as the result of an external shock, but it's rather the evolution of the deep crisis we have been living over the last decades. And that has not been faced efficiently, at least, by the existing multilateral structure, right? So we cannot fall in the trap of preaching that Trump is the only evil on earth and a return to the pre-Trump era is a solution. This is false for the whole world, but especially for peripheral countries. And I'll come back to this point later. So we need radical transformations in diverse fields, including, and this is our topic here, and very importantly, in the field of finance. Okay, history shows, and Richard also mentioned that, that important systemic transformations require important transformations in the international monetary and financial system. So in the mid-40s, after the war, there were some ideas related to the constitution of Bretton Woods. One of the main ideas was revamping trade. But then for that purpose, it was necessary to reform the international monetary and financial system. And reforming the international monetary and financial system, as my colleagues also said, is absolutely necessary today. And then we come to the discussion on climate finance. The need to create channels to allow for a green transition, or even better, to a just transition, and it's important to talk about the just transition, right? This is all extremely important. But then I come back to the first issue about multilateralism. If the reforms in finance, in the financial system, do not address the problems related to the failures of multilateralism, as we know it, big problems will persist. In other words, if the reforms in finance, in the financial system, do not address the problems related to the asymmetries of the international monetary and financial system, huge problems will persist, as my colleagues also said. So a departing point for me must be the discussion about the different perceptions we can have in the world on the dysfunctionality of the international monetary and financial system. We here in this room, we understand that the international monetary financial system is dysfunctional because it's not allied to the green transition, but also because precisely it's not allied to what we need in terms of multilateralism, right? It obviously reproduces the power correlations which are embedded in multilateralism, in the kind of multilateralism we had all over the last decades, which is full of problems, of flaws, of injustice, as we have been discussing also in the school with the students since Monday, right? It reproduces at the end the asymmetries which are the norm of the current multilateralism. And I don't need to waste your time with dozens of examples about, I don't know, the veto power that the US has at the International Monetary Fund, the scandalous interest rates that the periphery has to pay to have access to international capital. Charles just mentioned it, the limits in the autonomy of economic policy, and so on and so forth. So for us in this room, the international monetary financial system is dysfunctional. But does it mean that there is a global consensus on the dysfunctionalities of the international monetary and financial system? Does it mean that the international monetary and financial system is dysfunctional for capitalism, for the capitalist system? Not at all, obviously. It's extremely functional for the global north, for big wealth owners in the whole world, but in particular in the global north, right? Here in Campinas, we have been proposing that in addition to discussions on the international division of labor, we need to have deep discussions on what we name as the international division of finance. This was proposed by Humberto Lima, who made his PhD here, and then Edil Almeida, another PhD student, supervised by myself with Daniela Prates, and then the analogies. There are many analogies that can be built between the International Division of Labor and the International Division of Finance, right? And one of them, the most important maybe, is that there is a relation of dependency, but also of functionality of the periphery in its relation with the center, both at the International Division of Labor and also in this International Division of Finance. The periphery is not only dependent on the center, but it's also functional to the center in the sphere of money and finance, right? So the diverse problems which the periphery faces in relation to the dynamism of global finance are not a sign of dysfunctionality of the international monetary system from the point of view of the global north. It's rather related precisely to the functions of the periphery for this system, which are precisely offering exotic assets with high yields, which will be searched whenever there is appetite for the risk, for the valorization of portfolio of wealth owners, especially in the global north. So peripheral economies are articulated with central economies in a way which determines a process of net transfer of wealth from peripheral to central economies, and Jayati also mentioned it and showed some charts showing this transfer of wealth. Right? And when the so-called emerging markets are not enough for this transfer of wealth, international investors start going to new countries and to new areas. Right, so they go to the so-called new frontier markets, which are Senegal, Morocco, Pakistan, Sri Lanka, increasing the network of countries transferring wealth to the center of the system, and they go also to new fields, new areas. Right? So, well, why am I insisting on this point? Because when we look to the initiatives related to global finance, there are interesting and necessary things being done. But as a general rule, we see very important problems as well, problems related to the persistence of a system, which is structurally asymmetric. Rama, who is here, has also beautiful works on that, which provoke serious damages to the periphery of the world. So there are efforts to fix small problems of this system, such as the effort to include climate risks in the evaluation of assets. This is nice, but obviously far from enough. So our struggles, and this is my claim, is that to reshape the international monetary and financial system for greening the economy, this has to be articulated with an effort to face these very powerful asymmetries on the international monetary and financial system. Otherwise, the problems will persist, right? So when it comes for global finance funds, some very quick and general comments that we can explore later. First of all, they cannot be pro-cyclical, right? There is no sense in creating mechanisms that will allow for capital flow into the periphery during the boom, but interrupting it whenever there is a change in the international liquidity preference, which, by the way, is usually provoked by core countries, right? So the ecological crisis will not be waiting for the next boom. The flood in Pakistan will not be waiting for the next boom. And peripheral countries get affected by this instability, exchange rate, interest rate, etc. That's why development banks are so important, multilateral development banks, also national development banks. hopefully providing capital in a permanent way. Second, funds addressed to finance the green transition cannot mean larger indebtedness, obviously, of the Global South countries. And in particular, as was said as well, indebtedness in US dollars. It's the opposite, right? Debts in the Global South should be canceled or alleviated at least to open room for the green transition. This has been discussed in the meetings of the G20, but to the best of my knowledge, without great advancements on that. And also related to the debts in dollars, some investments obviously need for the green transition require dollar, but some not, obviously. And if the green investments all require dollar, then there is something which is really wrong, right? With these green investments, it's not possible to imagine that green transition that only require imported goods, machines, and technologies which are made in the global north. I'll come back to this very soon. Third, climate finance cannot mean conditionalities related to less space for fiscal policies in the global south. And again, it's the opposite. Fiscal policies will be more than ever necessary, not only for the green transition, but also for what has been named as the just transition. So many regions and many workers may be negatively affected by the green transition in an initial phase. And then social policy, fiscal policy, policies for job generation will be obviously necessary. Fourth point, and Charles mentioned that as well, and I can try to bring some more issues on that. There is an actor which is unfortunately protagonist in the determination of the dynamism of global finance, which is sometimes out of the scope, but we have to seriously discuss it, which are the credit rating agencies, as you said, Charles. So climate finance cannot rely exclusively on the judgments of credit rating agents. They have strong biases, right? Let's say it clearly, credit rating agencies make political judgments, even with racism, racist judgments. That's why it's so important to have an African credit rating agency. So on the assessments on public bonds issued by the Global South. And on top of that, there might be important problems also in the assessment of the multilateral development banks by credit rating agencies as well. In a moment precisely, and I've been learning with Marcos Vinicius about this whole discussion about the reforms that have to be done for by the multilateral development banks to become bigger, more efficient, and so on and so forth. And especially to deal with the new challenges, but especially to deal with ecological challenges. So also another discussion of the G20 in the last years, very important discussions. And then some of the reforms that the multilateral development banks have to do to be effective, they have to count on dialogues and negotiations with credit rating agencies, which will evaluate those banks, right? So which tend to be very hard. Later, Marcos Vinicius can maybe tell us about it. But so that's why I repeat, climate finance cannot rely exclusively on finance, which is subordinated to the judgments of credit rating agencies. Fifth and last one, we have to pay attention to the International Division of Finance, as I'm naming it here, but also to the combination of the International Division of Finance with the International Division of Labor. So it's a big problem to provide money for the periphery to only buy technology in the global north. And Pedro in this morning also mentioned that, to buy the solutions in the global north, to reinforces the asymmetries, right? So these are just some examples of structural trends of global finance that have to be addressed if we are thinking on the reforms that are needed at the international monetary and financial system. And then to conclude, I would claim that, well, we need multilateralism to shape the global climate funds. We need multilateralism to shape the global architecture for climate finance. We need multilateralism to face the humanitarian crisis we are now living, but we need obviously a new multilateralism not the one of Trump, which is non-existing, but not the one before Trump either. Okay? We need a multilateralism without asymmetries, with less asymmetries at least. It may be seen as impossible, and it is indeed extremely hard, but if the efforts to reshape global finance for a green transition do not take it into consideration, crucial problems will persist. And there are interesting, on a positive note, interesting initiatives being implemented. Charles mentioned some of them, which go in this direction of reforming the international monetary system to deal with the ecological challenges in a way which is combined with this reduction of the asymmetries of the international monetary and financial system. Thank you very much.
Very much. Want to emphasize this this idea of the global international financial system is dysfunctional to deal with the polycrisis and also to the greening of the economic transition and the importance of the dialogue between the stakeholders. So I pass the floor to the last one, Marcos Vinicius, please.
Thank you very much, Anna. Let me first express my appreciation to the organizers. Thank you very much for the kind invitation. And I also want to say that I'm very happy to be here. I'm a former student of this school. I did my undergrad here and also my PhD here. Very happy to see my professors again and see my colleagues that today are professors here at the school. Can you hear me better now? Yeah. I was just thanking people, so it's okay. Colleagues were mentioning the center periphery, and I think Pedro, Bruno, and others, how this is an important concept for this school. But glad to see that at least this week, Unicamp is at the center of the Global South discussions. So congratulations for the organizers. Here, my plan is to share two solutions or two instruments that we've been discussing around the World Bank. One is related to the hybrid capital, and I think many colleagues have been discussing the hybrid capital that we were able to launch last year. I know colleagues will say it's very little, Richard says very little, but it took us more than 2 years negotiating it, and we were able to reach some agreement on that, and I will be happy to share how we got the hybrid capital in place last year. And I also want to talk about another instrument, which is the Tropical Forest Forever Facility, something that Brazil is leading the design with the support of the World Bank, and we hope to launch it at COP30 as a new financing instrument for the climate and the biodiversity protection agenda. But before doing that, as this is a multilateral experience, I think just like other colleagues, I believe, especially now, today's outlook, it's very important that we step back a little bit and we talk about multilateralism, the need to protect it, to defend it. The multilateral institutions are under severe stress at this moment, and a stress produced by the very country that was at the center of the constitution of this architecture. And it's very important that before I talk about these two instruments that I want to talk about, we step back a little bit on the historical aspects and the building of this architecture. So let me see if I can do that. And this is something that this school talks a lot about. So before going to the post-Second World War, it's important to remind ourselves of what was the world after the First World War. And Keynes, he was a very young economist, member of the British delegation in the Treaty of Versailles discussions, and seeing what would be the outcomes of the treaty, he was quite upset, quite frustrated, and he went back to Cambridge and wrote this short book, The Economic Consequences of Peace, where he brought very harsh criticism to what the world was doing at that time, and he was very critical on the heavy reparations imposed to Germany, the architecture that the world was pushing at that time, the risks of the strategy to impoverish Germany and to isolate Germany from the world economy, on all the risks. That text, you can see that he somehow anticipates another conflict. He anticipates a new war in Europe, which unfortunately actually happened. He wrote that in 1919, right after seeing the consequences of the Treaty of Versailles. And the instabilities that this treaty created, I don't need to talk about much, but everybody know what were the consequences, the Nazi fascism and the tensions in Europe, and how this led to the Second World War. And then came the end there, and he was, of course, Bretton Woods is not exactly his plan. He was at the center of debates of Mr. White, and there's a huge literature around that. I don't want to go into this, and I can benefit of the brilliant presentation of Richard. But here I just want to highlight the difference in between what was the world after the First War and after the Second War, and how the Bretton Woods architecture was able to create what some authors will call the golden age of capitalism, and how this enabled a certain level of prosperity, especially in Europe, and how this was able to create a period of stability. I'm not saying it was a perfect system, it's quite unbalanced. All the costs of adjustments on the periphery, on the deficitary country, and so on and so forth. There are many criticisms for one to make, but here it's very important to recognize that the multilateral system that was built after the Second World War, with all limitations that we know, allowed a lot better environment for growth and recovery than the First World War. Well, and some colleagues will even go further, no, and say that what defeated Nazi fascism was not a military, but it was actually what was built after that. I want to go straight to talk about MDBs. One of the very things that was created at Bretton Woods was the World Bank, and maybe this is very obvious for everyone. And sorry, it's in Portuguese. But this is a very simplified diagram of how a multilateral development bank works. You know, what is the financial model that was created behind? And here is let me stand. Sorry. So what is an MDB from a financial point of view? An MDB is constituted by equity, right? So member countries, shareholders, they bring equity to form a bank. And the amount of equity you bring, it's of course what is your voting power. So the World Bank is of course an institution controlled by the G7. The US has 16% today. In Bretton Woods they had more. But today the US has 16%, and G7 together they have 42% of voting power of equity. But it's with this equity that the banks, Givida is borrowing. So MDBs, they go to capital markets. Most of them are AAA rated. They go to capital markets and they raise financing in the private capital markets. And this is how banks can leverage. I think Charles was talking about how the G20 is pushing banks to do the capital adequacy framework to be more prone into risk. So the G20 is pushing banks to leverage more. So the more borrowings you make, the more leverage you are, the more exposed to risk you are. And historically, these banks are quite conservative on how much they leverage, right? And the G20 is pushing them to leverage more. Today, the World Bank is roughly leveraging $1 of equity to 5 or 6. The G20 is pushing to go further. But then, of course, it's a difficult debate because some countries don't want to risk the AAA, and the more you leverage, of course, the more risk you have. But it's still a very conservative practice. No? And if you go to the balance sheet, these are the main components of the liabilities, no, of our bank balance sheet, no, equity and borrowings. And with these, the bank will form the asset portfolio, no, and then these banks are borrowing very cheap. They're AAA rated. They can go into capital markets, access financing quite cheap. They put a little spread and lend it to 20 years, 30 years maturity. And you build your assets portfolio, no? And you're financing roads, energy, social, and so on and so forth, whatever developing countries demand. These banks also maintain an liquidity portfolio in assets balance sheet. This is another source of conservativeness, because as MDBs have no access to central bank credit lines, they historically hold a huge amount of liquidity, more than 12 months often. For private bankers, this is absurd, but MDBs, they hold a lot of liquidity. And these are the main, if you go to the balance sheet of banks, these are going to be the main assets, right? The development assets and the liquidity assets. Since you're charging a spread here in this operation, your banks are generating an income, and with this income, you pay salary of people, travel costs, admin costs, you pay back your borrowings, and then you can do transfers to special funds, and then you have a net income, and with your net income, this goes back to equity, and the banks are sustainable, and they have an organic rate of growth, if you will. So this is very simplified way how an MDB financially works. Sorry if it's quite obvious to most of you, but I think it's important that we understand that. We've been listening often that the US taxpayers' money are giving money to, so it's not actually true. These institutions are self-sustained from a financial point of view. Where global north do bring a good contribution are on the specific funds, no? And then of course some funds are being now at risk because many countries are reviewing their capacity to contribute to the multilateral system. So this is very simplified way. And then of course after the World Bank there's a proliferation of MDBs. I don't need to go into that. And then let me go to the specific examples that I wanted to share. And the first one is on the hybrid capital. And this is something, as I said, took us more than 2 years negotiating it. The bank called it the framework for financial incentives, but I will focus on the hybrid capital. And what is the hybrid capital? The hybrid capital is basically a bond that the bank issues, but is a bond with a perpetual maturity. And as a bond with perpetual maturity, when the bank holds this into its balance sheet, rating agencies consider this as equity, okay? But it's not equity because it's not bringing voting power to countries that are bringing hybrid capital. This is why it's hybrid, because it looks like a bond and it looks like capital on the same time. It took years of negotiations with the member countries, which are a long time. At first, rich countries wanted to decide where the new money would flow into, and we were, no, this needs to be demand-driven, so it took us a long time. But last year, we were able to launch this framework, and the bank was able to get $11 billion in pledges from most of them Europeans, Japan, US also made a pledge at that time. And with this 11 billion, since the hybrid capital is considered as equity, that means the bank can leverage, right? So then with these hybrid capitals that the bank raised, so 11 billion, the bank will be able to make 70 billion in the next following 10 years. The pricing of this instrument is the regular pricing. It follows the regular spread. So there is no financial incentive for it. It's additional volume of financing. And it is directed to what the bank at that time called the global challenges. And of course, one of the main critical global challenge we face is the climate change, but not the only one. And then the way to make this framework with a financial incentive was to create what we call the Livable Planet Fund, and then to create a fund, and with that fund you could then subsidize pricing. Because as I said, the hybrid capital allowed the bank to reach higher levels of volume, but same typical pricing on that scheme that I presented. Problem here is that it's a very difficult moment to raise funding. The Livable Planet Fund, I think only Japan was able to make a pledge, and countries like Germany, they committed to transfer their coupon. I forgot to say that the hybrid capital pays back a coupon. Huh? So countries that bring a hybrid capital to the bank, they're entitled to get a coupon back, like any bond. But many countries have agreed to transfer the coupons instead to bring it back to their own national treasury. They will transfer these coupons to the Livable Planet Fund. For countries like Germany, they have committed to that. And then the idea is that the Livable Planet Fund would raise money, and then with that, you would be able to not only raise the volume, but also get a better pricing on that. And then you can blend, the regular architecture I explained before, with a Livable Planet Fund, which are grants, and then you can make pricing cheaper or longer. You can also extend the maturity. This is one. As I said, Richard and colleagues will say it's too little. The trillions are not there. We allowed the bank to raise 70 billion, but as I said, it was politically very difficult, and it was in a world where reaching consensus was easier than nowadays. And then the second instrument I would like to share is something that is being developed as we speak. Brazil announced the intention of designing it at COP28. And ever since that time, we were able to convince bank staff to help Brazil in the financial model designing. And we've been working very closely with other countries as well, from Global North, Global South, into the designing of the TFFF. I personally think it's difficult to say TFFF there. It feels like there's never enough Fs, TFFFF. But this is the branding that is built, the Tropical Forest Forever Facility. And the objective of the TFFF is to provide sources of financing for countries that have tropical forests and successfully protect them. This would be grants. This is not financing. And the TFFF is quite ambitious, trying to leverage an amount of money that would be relevant enough to raise the amount of resources every Ministry of Environment has, right? Usually, ministries of environment struggle in having their own funding, and the idea here is to build something that would be relevant enough to substantially increase the level of the budget of ministries of environment. And here the main idea then is to transform forests into a valuable asset. I will very briefly again talk about what is the financial model to kickstart our conversation. There is also the TFIF, which is investment fund. Legally speaking, we need to create two entities. I want to talk about why. It's basically what the board needs to approve one, and the board doesn't need to approve the other one. It doesn't matter. Formally they're two legal entities separate, but it's the same thing. So what is the TFFF? Investors would bring resources to this facility. These are not grants. These are not ODA funding. We all know that the ODA is being revised globally for multiple reasons. So these would be money that would come into the facility, and the facility would pay back a coupon. Okay. We would bring resources from sovereign investors and also private investors. And the ambition here is to get to 125 billion. No? If we can get to 125 billion, private investors and sovereign investors, we could make this very relevant from the point of view of paying protected hectares of tropical forests. The amount of sovereign is very little compared to the private, because here everyone is very aware of the difficulties on raising public financing. So this will be the first step. Get investors to join the facility, join the pool, and then what the TFFF will do, that money will be reinvested in emerging markets. Okay, and bringing these resources into emerging market would allow the TFF to generate an yield. Okay. With that yield, with that profit of investing this amount of money, that would allow the TFFF to pay back investors. And after paying back investors, the countries that successfully protect forests would receive then grants. So this is the general scheme. There's a huge discussion on what is the governance behind, the board behind. The idea is to have a secretariat at the bank. The World Bank would also host, the trustee would be at the bank. So there's a huge discussion. How do you measure forest protected? That would be done by satellite, but how do you audit that? There's a big discussion that is around that, huge technical work around that. But this is basically what is the structure of the TFFF. Our expectation is that we would be launching the TFFF at COP30 Belém in November, and this is in a very simplified way what is behind. So that's it. I think we have 1 minute left.
Well, before giving the floor to the audience, I want to congratulate all the 4 participants for the extremely amazing short lectures they gave us, and to enlighten the discussion of this important and relevant subject. So thank you for this wonderful session.